Every month, one number stops the Forex market in its tracks. The Consumer Price Index, CPI, can send currency pairs surging or crashing within seconds of release. If you have ever watched your screen spike on a news release and wondered what just happened, this is where you start. CPI measures the average change in prices consumers pay for everyday goods and services. Central banks watch it closely because it tells them whether inflation is rising or falling. When inflation runs hot, central banks tend to raise interest rates. When it cools, they may cut. Higher rates attract foreign investment, which strengthens a currency. Lower rates tend to weaken it. That chain reaction is why CPI moves Forex markets so hard and so fast. When the data drops, you will see two figures. Headline CPI covers everything, including food and energy. Core CPI strips those out because they are volatile and can distort the picture. Professional traders tend to focus more on core CPI because it shows the steadier inflation trend underneath. Both figures come as a year-over-year and a month-over-month percentage. The year-over-year reading gets the strongest reaction because it shows the bigger trend. But here's the key point. What actually moves the market is not the number itself. It is how that number compares to the forecast. A higher than expected reading typically strengthens the currency. A lower than expected reading typically weakens it. Preparation matters more than most traders realize. Before any CPI release, check your economic calendar, note the forecast and the previous reading, and review recent central bank language. If policymakers have already signaled concern about inflation, an above forecast print can trigger an even sharper move. Then look at the chart, identify support and resistance, and study how that pair behaved around the last 2 or 3 releases. When it comes to actually trading the event, there are 2 broad approaches. The first is entering on the initial spike. This is fast, aggressive, and difficult to execute. Spreads widen sharply in those first seconds. Slippage is common, and price can gap through your stop loss, meaning you exit at a worse price than you planned. The second approach is waiting for the dust to settle, usually 5 to 15 minutes, then looking for a clean entry in the direction the market has chosen. This misses the first move, but avoids the worst of the chaos. Whatever approach you use, reduce your position size on news days. Gaps and wide spreads can turn a normal-sized loss into a serious one. And keep this in mind. The market does not always move the way the numbers suggest. A strong CPI print can sometimes cause a currency to fall if the result was already priced in. Wait for price action to confirm direction before committing. Practice this on a demo account before risking real money. Trade several CPI cycles, take notes, and refine your process. The preparation habit alone will put you ahead of most retail traders.